Let's discuss more about the state of the banking industry. Joining us, Richard Beauvais, financial strategist, Rockdale Securities, and Chris Whalen, Senior VP at Institutional Risk Analytics. Dick Beauvais, start with you. Are we learning now that banks are not too big to fail? And somehow might this be good news rather than such bad news?
Well, I think there are three issues. I mean, certainly there's a lot of banks that are not too big to fail, and a lot of them will fail. So there are three issues you have to look at. Number one, there'll be a lot of small banks that will fail, somewhere between, we think, 150 to 200. Number two, and this is much more important, the cost of covering those failures is going to be extraordinarily high for the healthy banks. In other words, the healthy banks may have to set aside 25% of their earnings next year to pay for the failed banks. And that's going to cause their earnings to be less than people expect. The third issue is who's going to buy the failed banks. And I think that we've run out of names in the United States. U.S. Bancorp would be one company, but I think most of the buys are going to come from either foreign banks or private equity firms.
Yeah, I mean, Chris, that's one of the big issues right now. If you look at what the FDIC is talking about, an article in the Journal last week as well, there seems to be a big push on to get private equity involved in investing in some of these smaller banks. What does that mean? Do you think that's a good idea, and do you think they'll do it?
Well, we filed a comment letter on the rule. Basically, it comes down to this. We're going to run IPOs for troubled banks. Qualified investors are going to be involved. Firms like Dick's are going to be serving as the advisors. And I think we're going to have to give them some latitude on the control issue, but I also think that the funds are still going to have to put money on the table because, like all buy-side investors, what they're saying is we are not a control party. We're not the beneficial owner of the shares. Therefore, you can't ask us for more money a year from now if the bank gets into trouble.
But
and that's a tough issue for the FDIC and the other regulators.
The way that private equity operates is flies in the face of everything that is trendy right now. You know, they don't like to disclose exactly what they're doing. They like to put on a ton of leverage. They don't like a lot of control from the government.
Well, they'll have to disclose that they invest in banks.
Well, they can't shake it off, and I don't think it's a good idea that private equity firms buy banks. I think that
no, I agree.
What we're looking at is commingling, if you will, the financial sector with the industrial sector, and that's always been a mistake wherever it's been tried, and I don't believe that we should do it in this country, but we're desperate, and therefore when we're desperate we'll do things that perhaps we shouldn't do.
I think what we're going to see is something of a hybrid here. You have to have somebody in charge of the bank when the transaction closes. I suspect for large institutions above 25 billion in assets, that's going to be another bank. And I think you'll see the FDIC get creative as to how they get investors involved with a competent management team, which is the key.
I mean, Chris, step away just a second from the near term. Don't we have too many banks in the country? I mean, isn't that an ongoing issue?
No.
If you can resolve these failures, isn't that a good thing going down the road?
Well, we can resolve the failures, and we will, but back to the point about the industry and their contributions, I think it's fanciful to believe that the industry can finance this in the short term merely through assessments. I think that FDIC is going to have to formally pull on its credit line with the Treasury to keep the visible balance such that we don't cause public unease.
Yeah,
that's the issue.
Is that a big deal? I mean, that doesn't sound like a big deal.
It is a big deal because one-third of the assets are not covered. One-third of the deposits in the banks in the United States are not covered by FDIC insurance.
Look, Dick, they're paying out everybody. You know that.
I know they're paying them out, but they don't have to.
I understand that, but we're not willing to cross that Rubicon because our politicians don't want to turn to that very large chunk of non-residents and say, you're not covered.
But the thing is, Chris, what I find so interesting is that the bank stocks are doing so well, okay?
Well, there is no connection between the fundamentals and the stock price, Larry. Come on.
Okay, there's no connection. It's easy to say that, but you know, almost everybody else besides you believes credit conditions have been healing, liquidity conditions have been healing, and with bank earnings on the rise, maybe they can earn their way out of this. But I want to ask you, your pessimistic view is directly at odds with the action in the stock market for banks, including the July rally. How do you reconcile that?
July? That was late. You had to be in at the end of March.
I'm saying including the July rally.
The table in March.
Including the July rally.
Larry,
the banks are the second leading in, going back to early March.
Larry, you know better than this.
No, I'm asking you a question. Why is it, if the situation is so bad? All right, since early March, the bank index is up 140%. And even in this summer rally, it's up another 35%. Why is that if things are so bad?
Because the buy side is predominantly long, they can't take advantage of a short market. They were underinvested in financials for what, 3 quarters?
So you're saying people they're dumb. They just don't
had nowhere
understand the
else to
fundamentals.
go. Larry, we live in a fiat money system. They had nowhere else to go.
I agree with fiat money, but I don't agree about bank stock buying. You're telling me
Let Dick weigh in. I'm here laughing. Go ahead, Dick.
Dick Beauvais, you made a call 2-3 weeks ago to get out of banks. Since then, banks continue to rally.
Dick has been excellent.
Well, I think what's happening right now is
that
people are expecting the future a little bit too soon. In other words, you know, we were very aggressive in buying these stocks now, you know, at the beginning of the year, and now we've decided that the stock prices have moved so far that the multiples on future earnings are higher. In other words, the multiples on 2011 earnings are higher today than they were on average earnings over the past 5 years. Stocks have simply gone by their, if you will, fundamental values.
All right,
Chris,
Chris,
they will,
look,
however,
should you
earn
sell
their way out of this.
Chris, equal time on this. Should you sell them? I mean, is that your investment call? Should you sell the bank?
Look, Larry, what I'm telling my clients is they want to be out of the names that have run 100%, 80%, and the righteous, the Bank of Hawaii, the rest of them, maybe we look at those as a long.
Guys, we got to leave it there.